What happened last week in the stock market was insane. Stocks like Gamestop are growing from like $6 a share all the way up to like $400 a share. And this was due to just some regular investors in a group called Wall Street Bets on Reddit. And these people basically just exploited and they saw what the hedge funds were doing to these dying companies and took advantage of those short positions to make the stock price exponentially grow. But this video is not about that circumstance. This video is more in response to the circumstance and seeing people around me trying to jump on the bandwagon and try to get a piece of GameStop. But then there were people like me that were watching the real non-dying companies actually drop in price due to all this fiasco. So just the whole situation made me really want to make a video about just the basics of stocks. I want all of my fellow friends out there, or maybe anybody that's just getting into the stock market game, maybe even due to this whole GameStop thing, because I want people out there to make smarter, more informed financial decisions and not just treating the stock market like a game of speculation. Because at the end of the day, I really want people like us, just regular people, to have our best chance at creating real wealth for our future. So today I figured I'd make a video about my thoughts on stocks in general and my process in terms of evaluating them. And if that gets you all excited and you really want to see more from this engineer in Hawaii, don't forget to hit that like button and subscribe to the channel so you can join our growing family here on YouTube. And I guess because apparently we all need to say this, and as a disclaimer, I am not a financial advisor. These are just the things that I do, and you can use this information to make your own informed financial decisions in your investments. And with that out of the way, let's just start off with the basics. What is a stock? So a stock is a piece of a company. Keep that in mind, a piece of a company. So when you buy a share of, say, Google, you'll become a 0.0000000% owner of the company. But what drives the actual price of the stock? It can be a bunch of different things. It can be interest rates that are set by the Fed. It could be supply and demand in the economy, or just other trends in the industry, or whenever there's a time of uncertainty or fear. A lot of the ups and downs and the volatility in the market has nothing really to do with the actual company. It's just a bunch of outside noise that is affecting what the market is valuing each company at. I mean, just think about it. How many times when you're just at work at your own company are your day-to-day operations just so sporadic that maybe one day you're losing money, one day you're making money? For the most part, your operations are somewhat consistent. So that's why you can't treat stock prices as the underlying value of each company. In the long run, the market will always correct and show you what the true value of each company is. In the short run, you'll be dealing with all the ups and downs and the sporadic nature of probably just people's emotional decisions. So when you're talking about the mentality that you need to invest in stocks, I think some people get brought in by like the allure of day trading. Just sitting at your computer analyzing the charts and graphs and things like that. Especially if you don't do that for a living, or if you have like a real job. To me, you don't have the time to do all the proper analysis, and you're already setting yourself at a disadvantage for those who actually do this for a living. And yes, I'm sure you can have a one-hit wonder out there, but for the most part in the long run, you're probably gonna lose. And whenever I go into any investment, I want to try to see if there's as many ways as possible to give myself an advantage. So an advantage that people like us, just the regular people, have against those day traders is that we can think long term. These day traders have to show some sort of good earnings every single month, so they have to make trades and do all these different things so that they show some sort of positive growth. But for us, we can tune out all the noise. And we can really look at value investing and understanding how companies are going to grow over time. If we have the emotional stability and the long-term mindset when we invest in stocks, we can withstand all the different ups and downs in the market and look towards the future where the real growth will happen. Honestly, if you think that the stock market is just a fast and easy way to make money, it's probably going to be a fast and easy way for you to actually lose your money. So I'm a true believer in that you really need to understand value in the stocks that you're picking. And there's so much free information out there for you that there's really no excuse for you to take those little hints out there. Each little tidbit of information can put you in a better position for you to actually make money. And as we've seen through this whole GameStop thing, Wall Street's probably a little rigged. So we need to do our research. We need to put ourselves in a good position to succeed. So now that you understand how we can have a long-term mindset and how that gives us a competitive advantage, let's take a look at how we can evaluate stocks and have that better understanding of each company so that we can make a better decision. And to me, if you don't do any of this analysis, if you can't answer any of these questions, you probably shouldn't be investing in stocks. Or at least you better be prepared and okay with losing anything that you're putting into the markets. But let's evaluate. So when I first evaluate a stock, I try to look at somewhat of an overall view of each company first. So for our example, let's take a look at Tesla, which is a pretty trendy stock nowadays. So I'll look at what is the company's business model and how does it differentiate itself from its competitors. So though I'm not an expert in the car industry, I can kind of see the appeal of Tesla. I think that their designs are pretty cool. I think Elon Musk in himself is a differentiator from the rest of the market. And I do think that eventually we'll all go to electric cars as we're trying to go to zero emissions. So it's intriguing on that aspect. So now I look, is this company going to be used for a long time? And usually these items that are used for a long period of time and people are going to consistently use are kind of boring items. Chewing gum, for example. Things like that, just regular commodities that just seem timeless. But for something like Tesla, I do think that it's going to be around for a while, as long as Mr. Musk is around. But again, I do see that future prospect of having electric cars. I do think that the autonomous feature of the cars also will be a thing. But there's also that risk that maybe we may go away from cars altogether. So now that we've covered some of the conceptual things, we'll go deeper into technical aspects. So we'll look at the market cap, or essentially the total value of the company as dictated by the market. So it's essentially what is the value of all the outstanding shares of the company. So for Tesla, that'll be $752 billion. So if you're really business savvy, you could probably make a very good determination just based upon market cap. So if you believe that Tesla's a $1 to $2 trillion company, and you see that the current market cap is at $752 billion, you know that the stock is going to grow in the future, so it's worthwhile investing in. But for regular people like me, I couldn't tell you what this company is really going to be worth in the future. I don't even know what a $6 billion company is, or a $300,000 company. So I gotta dig a little bit deeper. There's things called 10Ks and 10Qs, which are annual and quarterly reports. And these have information about the company's financial statements, and there's actually some excerpts in there about company outlook, and I found some really interesting stuff in Tesla's about actually the risks of the operation. So I'll throw a couple of those little paragraphs in here, and it really gives you a very good outlook on the company. And I know it's not very glamorous reading, but anything to help you learn more about the company and understand their current position, I mean, it helps you make a better decision for your own money. And after you read that report, we can dive deeper into the numbers. So there's 6 little metrics that I look at to kind of get an idea of where this company stands financially. So I'll first take a look at the price to earnings ratio, or the PE ratio. And this takes the current share price and divides it by the annual earnings per share. And it's essentially what you pay for each dollar of earnings in the company. And what you need to do is you need to compare that PE ratio to other companies within the industry. The lower the PE ratio, the more undervalued the company is. So Tesla is at a whopping 1,517. For reference, you have companies like GM, Honda, Toyota that are at 22, 19, and 14. So by looking at just the PE ratio alone, one might think that Tesla could be overvalued. There's also another thing called the forward PE ratio, which projects this ratio over the next 12 months. And for Tesla, it's at about 208, which is a lot better than 1,000, but it's still kind of high. But what it does tell is that there's a lot more projected earnings for Tesla, so that's something that I'm looking at. And you can kind of see that when you really dive into their analytics, that this company really is growing at a rapid pace. So another thing that I look at is the price to book ratio. And what this is the current share price divided by the current book value per share. And a book value is essentially your assets minus your liabilities. So if your price to book ratio is above 1, that means that the current stock is trading at a price that's higher than your assets. And if it's below 1, that means that it's actually lower than your current assets and means that it's probably undervalued. And you can think of your book value as like your own net worth, right? Your assets minus your liabilities. That's on paper what you could just be worth. So Tesla's is at around 60, which again is another indication that potentially Tesla could be overvalued. And the last thing that I'll check is the PEG ratio, or the price to earnings to growth ratio. And basically it projects out any amount of years what the actual growth rate of the company would be and kind of adjust your PE ratio. It's very similar to the forward PE ratio, but it puts a bigger emphasis on the actual growth rate. Anything below 1 means that the stock is potentially undervalued. So Tesla, according to Yahoo's analytics, is at a 1.7, which again kind of shows you that Tesla's earnings really are shown to be really growing, but at its current price, maybe that's still a little high. So now we'll look at return on equity, which is calculated by taking your net income and divided by your shareholders' equity. And what this tells you is your net return on your assets. So you're trying to see how this company uses their assets to make money. You really want to see this number in the double digits. If you think about it, the S&P 500 index is targeted at around 14%. So if you're investing in individual stocks and you're taking that risk, you should be way above that. Anything over 20% is really good. But Tesla is at a 5.59%, which just based upon this thing alone tells you that Tesla could probably use their assets a little bit better to make money. And now we'll look on return on invested capital, which is the net operating profit divided by the invested capital. And this basically tells you how the company uses its investments to make profit. So you want this one to be pretty good. Very similar to your return on equity. You want to see this number in the double digits, and Tesla is kind of below that. And when you do a lot more research about this, you actually tell that Tesla's actually using a lot of their liabilities to grow, which is not always necessarily a bad thing. It's just maybe a little bit riskier than you would like. And speaking of liabilities, that's where I'll take a look at my last thing, the current ratio, which is just the ratio of your assets over your liabilities. So Tesla's current ratio is now 1.63. However, that wasn't always the case. Remember what I said earlier, Tesla was using a lot of its liabilities to grow. And that's kind of typical. You can kind of see that Tesla is actually growing as a company. So they're trying to use and leverage their liabilities to actually create growth. And now in recent years, they're starting to see themselves move more into the positives, which is really good to see. And sort of related to the current ratio, you can kind of calculate how many years it's going to take the company to pay back some of their debt. So if you divide the long-term debt by the free cash flow, and you want to use free cash flow in this calculation because you want to take into account your capital expenditures, not just your overall operating cash flow. So for Tesla's long-term debt, it looks like about 11 billion, and their free cash flow is about 2 billion. So it's going to take about 5 years for them to pay off all that debt, assuming that their cash flow is remaining the same. So what did we learn here? So for me, taking all this information together, I'll probably buy maybe a share or two of Tesla. But because of its current financial position, and the fact that when you really run the numbers, at least as of right now, it really seems like the company is a little overvalued. It's seen as more of a riskier pick. On paper, that is. But honestly, I really believe in the company. I only hear really good things about their products, and I have so much respect for Elon Musk that he's kind of just one of those guys that you really don't want to bet against. So I see it as a high risk, high reward stock, but not something that I'm going to put all my life savings in until the numbers start to work out a little bit better. And also, I'm self-aware enough to know that I'm no expert in the automotive industry. So that's another reason why too, I don't want to put too much of my money into this sector. So as you can see, going through this whole process gives me a good understanding and a good way for me to make a very informed decision on my stocks. And I hope this video gave you some value and perspective out there to actually really analyze these companies and understand where you're putting your money. Because all of you out there work too hard to just lose your money in the stock market by just guessing out there. There's ways for us to make informed decisions, have a good long-term mindset, and really build growth in the stock market. So if you have any more questions for me about this topic, feel free to comment below. I would love to hear all of your thoughts about stocks or maybe some analytical techniques that you guys use. I really hope you enjoyed the video. If you did, don't forget to hit that like button, subscribe, and hit the notification bell so you can join our growing family here on YouTube. Thank you so much for watching. I really appreciate your time, and I'll see you on the next video.